Impact Report forecasted 50% increase in institutional adoption across 4 key industries by Q2 2025. Date, February 2, 2025. Event time, 19 hours 44 minutes and 45 seconds. Overview. As we look towards the second quarter of 2025, institutional adoption across 4 key industries, finance, technology, retail, and real estate, is projected to experience a remarkable 50% increase. This report synthesizes insights from various industry sources highlighting the anticipated developments, challenges, and opportunities that will shape these sectors in the coming years. Key insights. 1. AI and technological integration. The rapid integration of artificial intelligence (AI) across sectors continues to be a defining trend. Experts agree that AI will significantly enhance operational efficiency, customer experiences, and risk management. By Q2 2025, financial institutions are expected to increasingly utilize AI for predictive analytics and fraud detection, while generative AI is anticipated to become a standard operational component. Finance, AI systems will automate basic tasks, enabling professionals to focus on strategic decision-making. For instance, AI-driven tools will assist in loan underwriting and risk assessment, streamlining processes and improving accuracy. Technology. The rise of AI agents capable of executing complex tasks is predicted to enhance productivity across various business functions. Companies leveraging these technologies are expected to gain a competitive edge. 2. Real-time payments and transaction efficiency. The forecasted growth in real-time payment systems is another critical theme. By mid-2025, real-time payments are expected to be standard in financial transactions, driven by high consumer demand and regulatory support. Institutions are expected to implement systems that facilitate instant transactions, thereby improving cash flow and overall operational efficiency. 3. Sustainability and ESG adoption. Environmental, social, and governance (ESG) factors are gaining traction as institutional investors focus on sustainable practices. The shift towards green financing is particularly pronounced in real estate, where there is an increasing demand for sustainable products and solutions. Companies that integrate sustainability into their business models are likely to attract more investment, particularly from younger generations who prioritize ethical considerations in their financial decisions. 4. Regulatory environment and compliance. The regulatory landscape is evolving, with significant changes anticipated in the EU and US that will impact operational practices across financial services. The implementation of the Digital Operational Resilience Act (DORA) will require financial institutions to bolster their cybersecurity and risk management frameworks. Institutions must navigate new compliance requirements while ensuring they maintain operational continuity and consumer trust. Timeline of anticipated developments. 2024. Following a volatile 2023, experts predict a stabilization period with gradual interest rate cuts in the US and UK expected to bolster market confidence. Q1 2025. The implementation of DORA in the EU will compel financial institutions to enhance their cybersecurity measures, making compliance critical. Mid-2025. The launch of several stablecoin projects and advancements in real-time payment systems are expected to reshape transaction processes, particularly in cross-border payments. End of 2025. Increased institutional adoption will lead to a more pronounced integration of advanced technologies, resulting in personalized customer experiences and operational efficiencies. Challenges and opportunities. Challenges. Compliance. The evolving regulatory framework poses challenges for institutions, especially in adapting to new requirements while maintaining efficient operations. Market volatility. Economic uncertainties, particularly surrounding inflation and geopolitical tensions, may impact investment strategies and market stability. Opportunities. AI-driven efficiency. institutions that embrace AI can streamline operations and enhance customer service, positioning themselves favorably in a competitive landscape. Real estate innovations. The growing demand for sustainable real estate solutions presents opportunities for investment in green technologies and practices. Conclusion. The convergence of AI, real-time payments, sustainability initiatives, and regulatory changes is set to redefine institutional practices across finance, technology, retail, and real estate. As we approach Q2 2025, stakeholders in these industries must adapt swiftly to capitalize on the emerging opportunities while effectively managing the associated risks. The forecasted 50% increase in institutional adoption signifies a pivotal moment for these sectors, underscoring the need for innovation, compliance, and a commitment to sustainability. This report aims to provide a comprehensive overview of the expected developments and trends shaping the future of institutional adoption across key industries by mid-2025. Stakeholders are encouraged to leverage these insights to inform their strategic planning and operational frameworks in the dynamic and evolving landscape of finance, technology, retail, and real estate. The forecasted 50% increase in institutional adoption across the finance, technology, retail, and real estate sectors by Q2 2025 reveals several counterintuitive aspects worth exploring. 1. AI and human collaboration. A prevailing narrative suggests that AI will replace human jobs in the financial sector. However, many experts predict a shift towards using AI as a complementary tool rather than a replacement. For instance, banks are likely to utilize AI for repetitive tasks, enabling human employees to focus on strategic decision-making and higher-value interactions with clients. This perspective challenges the common fear of job displacement, emphasizing a partnership model instead. 2. Regulatory environment and innovation. While a common assumption is that increased regulation stifles innovation, the analysis indicates that regulatory frameworks like the EU's Digital Operational Resilience Act (DORA) may actually foster a more secure and innovative environment. Companies that adapt to these regulations are expected to enhance their operational resilience, which could ultimately lead to greater trust from consumers and investors, thus promoting growth and innovation. 3. Sustainability as a competitive advantage. Many businesses view sustainability initiatives as a cost burden. However, the forecast suggests that those integrating environmental, social, and governance (ESG) principles into their core strategies will find new opportunities for growth. Firms that prioritize sustainability are expected to attract more investments and customer loyalty, illustrating that being eco-friendly can be a market differentiator rather than an expense. For real estate market dynamics, in real estate the expectation is that high interest rates would deter investment. Instead, experts anticipate a resurgence in certain property sectors. The shift towards build-to-rent developments and co-living spaces highlights a changing consumer demand that prioritizes affordability and flexibility. This indicates that while traditional views predict a downturn in real estate due to economic pressures, adaptive strategies may lead to unexpected growth in specific segments. 5. Consumer behavior in payments. The rise of digital payments and preferences for instant transactions contradicts the notion that traditional banking methods will dominate indefinitely. As consumers increasingly gravitate towards digital wallets and real-time payment systems, businesses that cling to outdated models may find themselves at a competitive disadvantage. This shift showcases a clear move towards convenience and speed over tradition. 6. Talent shortage and opportunity. The belief that a talent shortage in finance will cripple innovation overlooks the potential for fintechs and traditional banks to harness AI and automation to fill gaps. As companies streamline operations through technology, they may actually enhance productivity, thus mitigating the effects of the talent drought. This presents a scenario where the integration of new technologies could lead to a more efficient workforce rather than a diminished one. 7. The role of community banks. Contrary to expectations that larger institutions will dominate post-recession, community banks may actually gain market share by offering personalized services and building closer relationships with clients. The forecast suggests that these smaller banks can thrive by focusing on local markets and customer service, challenging the notion that size alone guarantees success in the financial landscape. 8. Impact of political leadership on economic policy. The incoming Trump administration is expected to significantly influence economic policies, yet the implications of these changes may not be as straightforward as anticipated. While deregulation might appear beneficial for growth, it could also introduce volatility and uncertainty into the market, requiring firms to adapt rapidly. This suggests a complex interplay between policy changes and market behavior that defies simple predictions. 9. Increased focus on data privacy amid AI adoption. With the rise of AI and machine learning, the assumption might be that companies will prioritize speed and efficiency over data privacy. However, many institutions are expected to emphasize robust data governance frameworks in response to growing regulatory scrutiny and consumer demand for privacy. This reflects a shift towards integrating ethical considerations into technological advancements, challenging the stereotype of profit-driven motives. 10. Evolution of payment solutions. The integration of payment solutions into non-financial services contradicts the notion that financial institutions will always be the primary providers of payment services. As retail and tech companies expand their offerings to include financial services, traditional banks may need to rethink their roles and adapt to this new landscape of embedded finance, indicating that competition will increasingly come from unexpected quarters. These counterintuitive insights underscore the complexity of the evolving institutional landscape across key sectors, indicating that adaptability, strategic foresight, and a willingness to embrace change will be crucial for success by 2025. Key insights from the report on institutional adoption by Q2 2025. The projected 50% increase in institutional adoption across finance, technology, retail, and real estate by Q2 2025 encompasses various trends and developments. However, certain nuanced details are often overlooked, which can significantly impact strategic decisions. Below, I will identify these overlooked aspects and explain their significance. 1. Integration of AI and technology across industries. While the report highlights the integration of AI across various sectors, the specific applications and potential pitfalls are often glossed over. For instance, AI's role in predictive analytics and fraud detection is crucial. But the reliance on historical data can perpetuate biases. Financial institutions may overlook the need for diverse data sets and ongoing adjustments to ensure that AI systems adapt to evolving contexts. Significance. Failure to address these biases can lead to skewed decision-making and regulatory scrutiny. As AI becomes a cornerstone of operations, companies must implement robust frameworks to monitor and adjust the algorithms, continually ensuring equitable outcomes. 2. Real-time payments and consumer expectations. Although the rise of real-time payment systems is mentioned, the implications for consumer behavior and business operations are underemphasized. The transition to real-time payments necessitates not only technological upgrades but also a cultural shift within organizations to prioritize speed and efficiency. Significance. Businesses that underestimate the impact of consumer expectations for instant transactions risk losing market share to competitors who adapt swiftly. The ability to meet these expectations will be a key differentiator in customer loyalty and satisfaction. 3. Sustainability and ESG efforts. The emphasis on environmental, social, and governance (ESG) factors is noteworthy, yet many institutions may not fully grasp the operational changes required to align with these principles. The report hints at the growing importance of sustainable practices but does not delve into how these practices will necessitate changes in supply chain management, investment strategies, and stakeholder engagement. Significance. Institutions that fail to integrate ESG into their core strategies may face reputational risks and investor backlash as public scrutiny intensifies. Proactively managing ESG factors can enhance brand value and foster trust with consumers increasingly concerned about sustainability. 4. Regulatory developments and compliance. Anticipated regulatory changes, particularly with the implementation of acts like DORA, are mentioned but not extensively analyzed in terms of how institutions will need to prepare. The implications for operational resilience and cybersecurity are profound, yet the need for an ingrained compliance culture is often understated. Significance: organizations that view compliance as a mere regulatory hurdle may not effectively mitigate risks associated with data breaches and operational disruptions. A proactive compliance culture can not only safeguard against penalties but also enhance organizational agility and reputation. 5. Talent acquisition and skills gap. The report outlines the growing need for skilled professionals, particularly in AI and data analytics. However, it often overlooks the strategic implications of a potential talent shortage, especially as older generations retire. Companies must not only focus on attracting new talent but also on reskilling existing employees to bridge the gaps. Significance: firms that neglect internal talent development may find themselves unable to implement new technologies effectively. Investing in training and development can enhance employee engagement and retention, ultimately leading to a more resilient organization. 6. Mergers and acquisitions M&A landscape. The anticipated increase in M&A activity is highlighted, but the complexity of integrating different corporate cultures and systems post-merger is often downplayed. The report suggests optimism around consolidation but does not address the challenges that can arise from these integrations. Significance: companies that underestimate the cultural and operational challenges of M&A may experience high turnover rates and disruptions in productivity. Successful integrations require careful planning and a focus on aligning values and operations. 7. Cybersecurity and fraud prevention challenges. While the report mentions the rising threats of fraud and the importance of cybersecurity, the specific strategies for implementing effective fraud prevention measures are not thoroughly explored. Emerging technologies like AI can both aid in fraud detection and become tools for fraudsters. Significance: organizations must adopt a multi-layered approach to cybersecurity that includes both technology and human oversight. As fraud tactics evolve, continuous investment in security measures will be essential to protect sensitive data and maintain consumer trust. 8. Cross-border payment innovations. The report discusses the anticipated growth of cross-border payments but often misses the operational complexities involved in these transactions. Regulatory differences, currency fluctuations, and transaction costs can create significant hurdles for businesses. Significance: firms must invest in robust cross-border payment solutions and stay abreast of regulatory changes to ensure compliance and cost-effectiveness. A failure to navigate these challenges can lead to lost business opportunities and increased operational costs. Conclusion: the projected 50% increase in institutional adoption across key industries by Q2 2025 presents a landscape rich with opportunities. However, the overlooked aspects discussed above are critical for organizations aiming to capitalize on these trends. Addressing these nuances will not only prepare institutions for the upcoming changes but also position them for long-term success in an increasingly competitive and regulated environment. By fostering a culture of agility, compliance, and innovation, organizations can navigate the complexities of the evolving market landscape effectively. 1. AI and technology integration across industries. The increasing adoption of AI and technology is projected to revolutionize the operation of institutions across finance, technology, retail, and real estate by 2025. In finance, AI will enhance predictive analytics for risk management and fraud detection, while in retail, AI-driven personalization will significantly influence consumer experiences. The expected integration of generative AI into various sectors will improve operational efficiency, customer interactions, and strategic decision-making processes. Furthermore, this shift will establish a new standard for service delivery, compelling institutions to adapt to maintain competitive advantages. 2. Real-time payments and payment innovations. The rise of real-time payment systems is anticipated to redefine transaction processes across industries by 2025. This trend will facilitate improved cash flow management for businesses driven by consumer demand for instant transactions and regulatory support. Innovations such as embedded finance and alternative payment methods will further enhance the customer experience, allowing seamless transactions across various platforms. As real-time payments become the norm, institutions must ensure their systems are equipped to handle the increased volume and complexity of transactions while maintaining security and compliance. 3. Sustainability and ESG integration. Environmental, social, and governance (ESG) factors are becoming critical components of investment strategies and business operations. The emphasis on sustainability is expected to grow, influencing real estate, finance, and retail sectors. Institutions will face pressure to integrate sustainable practices into their models, driving demand for green financing and responsible investment strategies. The anticipated rise in regulations surrounding ESG reporting will necessitate a shift towards transparent practices, making sustainability not just a compliance issue but a strategic priority for long-term growth. For regulatory changes and compliance dynamics, the landscape of regulatory requirements is evolving rapidly, particularly in sectors like finance, where new regulations such as the Digital Operational Resilience Act (DORA) will come into effect. These changes will compel institutions to strengthen their compliance frameworks and enhance operational resilience. The anticipated divergence in regulatory approaches, especially between the EU and the US under the new administration, will create complexities for institutions operating across borders. Firms will need to invest in compliance technologies and practices that can adapt to this changing environment, ensuring they meet both local and international standards while maintaining customer trust. These 4 points highlight the critical areas for in-depth analysis and strategic discussions as institutions prepare for the anticipated landscape in 2025, emphasizing the interconnectedness of technology, regulatory frameworks, sustainability, and operational practices across key industries. 1. The rise of the Internet and e-commerce. 1990s to 2000s. The rapid adoption of the Internet drastically transformed various industries, including retail and finance. E-commerce platforms like Amazon and eBay emerged, revolutionizing how consumers shop and businesses operate. This shift led to an increased focus on technology integration, customer experience, and supply chain efficiency, similar to the current trends of institutional adoption of real-time payments and AI technology across multiple sectors. 2. The dot-com bubble. 1997 to 2001. During the late 1990s, there was a massive surge in internet-based companies and investments, leading to a speculative bubble. Many startups focused on e-commerce and technology saw their stock prices soar, only to crash dramatically in the early 2000s. This historical example illustrates how rapid technological advancements can lead to both opportunity and risk, reminiscent of the current excitement surrounding AI and fintech innovations, with potential pitfalls of overvaluation and unsustainable business models. 3. The global financial crisis. 2007 to 2008. The financial crisis was triggered by the collapse of mortgage-backed securities and high levels of debt in the financial system. In the aftermath, regulatory reforms like the Dodd-Frank Act were introduced to enhance transparency, risk management, and consumer protection in the financial sector. This mirrors the ongoing regulatory changes and compliance pressures that institutions are facing today, especially concerning AI, cybersecurity, and financial transactions, as they adapt to a rapidly evolving landscape. Future outlook: predicted 50% increase in institutional adoption across key industries by Q2 2025. By the second quarter of 2025, a 50% increase in institutional adoption across 4 key industries, finance, technology, retail, and real estate, is anticipated. This projection is driven by several interrelated trends, including advancements in technology, regulatory changes, evolving consumer preferences, and a heightened focus on sustainability. 1. Finance sector transformation. The finance sector is poised for significant changes influenced by the increased integration of artificial intelligence (AI) and real-time payment systems. By 2025, financial institutions will leverage AI to enhance risk management, fraud detection, and customer service through intelligent automation. The shift towards real-time payments driven by consumer demand for faster transactions is expected to become the standard, improving liquidity and operational efficiency. Key predictions. The adoption of AI in risk management will enable institutions to automate compliance processes and enhance decision-making capabilities. Regulatory frameworks like the Digital Operational Resilience Act (DORA) will necessitate stronger cybersecurity measures, compelling financial institutions to modernize their infrastructures and risk management strategies. The rise of stablecoins and digital currencies will transform cross-border transactions, offering enhanced speed and transparency while addressing the inefficiencies of traditional payment systems. 2. Technology sector advancements. The technology landscape, particularly in financial services, is expected to witness a surge in AI-driven solutions and a shift towards more personalized user experiences. Companies will increasingly utilize agentic AI, which enables automated decision-making and enhances productivity across various functions. Key predictions. AI will enable hyper-personalization in banking services, providing tailored financial advice and improving customer engagement. The integration of AI into core banking systems will facilitate seamless and efficient transaction processes, allowing for real-time data analysis and enhanced customer support. As the regulatory environment evolves, businesses will prioritize compliance and data governance, ensuring responsible AI deployment and mitigating risks associated with data privacy. 3. Retail sector evolution. The retail industry will continue to adapt to changing consumer behaviors and preferences, with a strong emphasis on digital transformation. The rise of e-commerce and mobile payments will drive innovations in payment processing, enabling businesses to offer more varied and flexible payment options. Key predictions. Retailers will increasingly focus on first-party data to enhance customer engagement and personalize marketing strategies. The implementation of AI in inventory management and pricing strategies will optimize operations and improve profit margins. The growth of embedded finance solutions will allow retailers to integrate financial services directly into their platforms, enhancing customer convenience and driving sales. 4. Real estate market dynamics. In the real estate sector, sustainability and regulatory compliance will become pivotal factors influencing investment decisions. The demand for green buildings and energy-efficient properties is expected to rise as investors seek to align with environmental, social, and governance (ESG) criteria. Key predictions. The integration of technology in property management will enhance operational efficiency and tenant experiences, leading to higher occupancy rates and rental yields. Regulatory changes will drive the adoption of sustainable building practices, prompting developers to invest in green technologies and materials. Co-living and build-to-rent models will gain traction, catering to the growing demand for affordable housing solutions in urban areas. Conclusion. As we approach mid-2025, the convergence of AI, real-time payment systems, sustainability efforts, and regulatory changes will reshape institutional practices across finance, technology, retail, and real estate. This anticipated 50% increase in institutional adoption reflects a broader trend of digital transformation, with organizations needing to adapt swiftly to meet evolving market demands. The emphasis on efficiency, personalization, and sustainability will not only create challenges but also open up significant opportunities for innovation and growth across these key industries.